plus general synergies. So what are general synergies? General synergies are defined as any benefit arising from the acquisition that will be realized by all the potential bidders for that particular company. So all the benefits arising from an acquisition by all the potential bidders for that valuation subject. So if we are saying that there is an opportunity to do what? There is an opportunity to acquire a small clothing retailer. By who? By the big established ones, your Truworth, your Edcon, and what? Your Mr. Price. So if now we are saying that all of them are interested in acquiring this company, and when we analyze the deal, we discover that they all have an intention to close some of the stores. And the idea is that they are planning that the stores will be closed and they will save rental, and the stock that will be bought from that particular company will then have a space in their own what? In their own existing stores. So what we are now saying is that since all the potential bidders have a plan to close the stores and save on the rental, we are now saying that's a general synergies that every potential bidder for this company will have. And as a result, when we include those synergies, we end up with what? We end up with the fair value altogether. So what will then happen is that you will calculate the value of 100%, and you will add on to it the value of any synergies that are given in the scenario altogether. Then after you've added the synergies, that's when you will multiply by the percentage shareholding that we are acquiring. But what we are just saying is that you will follow the entire structure, and under value of 100%, you'll say plus general synergies. And you will have the total fair value of the company. And you'll then say, but my interest is only 80%, multiplied by 80% shareholding. Does that make sense? So that is what we mean. And therefore, when you read these questions, pay careful attention to which value they are looking for. Then,
the market discount, marketability discount.
Yeah.
But when do we add and do we deduct?
We deduct. So the plus means that we are bringing this and they're adding. Whereas the minus will be the things that we will deduct. In other words, from any number we've got. So let's say you get here and you say, what is the marketability discount? Then the marketability discount, it's also a percentage of the value. So you can say it's 5%. So if it is 5%, it is 5% of what? It can be 5% of the number right here. So it means that you will have added these numbers together. Maybe you end up with what? With 3 million. So then it will be 5% of 3 million that you will deduct here.
Okay, when do I deduct? When do I say it's a deduction, it's marketability? What am I looking at for me to say choose?
Yes, so marketability says that the transferability of the shares are limited. And generally it arises because the company is unlisted.
Okay. Oh,
Yes. Okay. So the term is coming from the fact it's not easy to market this. So if I've got shares on the JSE, I can just log onto my online profile and say sell. There will be a market that is going to buy those shares. So that is not available for an unlisted company, and that's why we are saying there is a discount that we are willing to put because of that limitation.
So the percentages are just based on judgment. Like, is there a minimum and a max, like when it comes to marketability?
There
From
isn't.
5 to 10.
There isn't. There isn't. Yes. So sometimes when you are done with the CTA, you can Google PwC valuation report. So they go around looking at transaction and saying what was the marketability discount achieved, the WB transaction, what was the login period. So they analyze all these other things. And you'll see that they will say that over the past 5 years, they've seen discounts ranging from 10 to 30%. And they'll say the average though was 15. Yes, so there is no right or wrong. It's how people feel. Because I could be sitting here and saying that, but if this investment is not doing so well and I want to sell it, I don't have anyone to sell it to. So I want a discount of 30%. So that is the idea behind it. So even from an exam perspective, we are not interested in the number you pick. We are more interested in what is your reason and whether it's a plus or a minus. Yes. Sure.
Surplus cash
Yes.
after calculating the If you're using a forward multiple, you also increase the cash by, say, inflation.
No, the cash is always based on the cash at the date of valuation. Yes. So usually the valuation in these questions will be done at reporting date. So there might be a balance sheet and they say that the cash on 31 December 2018, which is the last trading date or the reporting date, is 500,000. So the cash is not adjusted. Yes. So the cash is always at a particular point in time. Even for a DCF, even there, if there's cash changing over the years, you are focused on the cash at the reporting date.
I'm confused with regards to the market stability discount, because I think I would have deducted it from the beginning when you're doing your PE, when you do those adjustments, whether you add or subtract. So would I be duplicating if I had started with it in the beginning and I said, okay, it's not JSE listed, -1 or +1?
Yes, and it's actually a good point because the idea is that the adjustment of marketability needs to be made once. So if you make it on what? If you make it on the multiple, it's fine. Then you have what? You will have your mark there. But then you will not need to make it again here.
Because that's what I want.
Yes, so if you didn't make it in the multiple, then you will need to make it here. What I've seen in one of the previous exams is that they seem to have a preference to put it here. And the reason I'm saying that is that in the same exam, they said that if you put it as part of the multiple, there was 1 mark. But if you put it as part of these adjustments here, it was a 2 mark. So I'll say that to try to maximize your marks, rather try to put it here or just consistently put it here. Yes.
So if you put it twice, are you going to be?
Yes, if you put it twice, no marks. Yes. So at least let it be 1, not in both places. Yes.
Where does the PE valuation and the MBIC and the EBITDA differ?
So we're going to talk about that before we leave. Yes, we're going to, yeah.
Okay, since the bottom is the same.
And it's only one subtle difference. Yeah, just well, you need to just remember one thing. We're going to address it before we move. So are we clear with this? So now, sometimes they will ask for the maximum value. So again, if they say determine the maximum value that the company should be willing to pay, then what do we have? Then we have the fair value plus what? Specific synergies. So specific synergies are those synergies that are only attributable to a specific bid altogether. So these synergies will then be defined by saying that if we go back to that clothing retailer example, we'll then say that if we acquire this particular company, then we will have the ability to we'll have the ability to sell a head office building. And other companies, because they don't have their own head office building, they will not be able to sell it. So because I am the only one who's got the capacity and the ability to sell an asset and make more money, then that is a benefit that is only attributable to me. And as a result, we call that a what? We call that a specific synergy altogether. And we'll only include it if and only if they ask for a maximum value. Does that make sense? So that is then the framework, and that is where you get an integration between valuation and mergers and acquisition. It is how the question has been what? Has been phrased. So go back and just check some of these questions carefully in terms of what they were asking for. And then you'll be able to pick up, I think even in test 2, for both level 1 and level 2, they were specific in terms of the value they wanted. And then you'll see that after they've done all this, they did something extra in order to account or to respond to that particular requirement. Is that clear? So now, when we talk about EV, EBITDA, or MVIC, EBIT, MVIC, EBITDA multiple, the approach is the same. In other words, we first need to determine your maintainable earnings, and we need to multiply by the multiple. The only difference is that when we talk about maintainable earnings now, we might be referring to an EBITDA altogether. So when we talk about maintainable earnings, we might be referring to maintainable EBITDA. And if I'm referring to a maintainable EBITDA, it essentially means that I need to consider the definition. I need to consider the definition. So the definition is earnings before interest, depreciation, debt, and amortization. In other words, we have not deducted interest this time around. We have not deducted tax. We have not deducted depreciation and amortization. Meaning that if they give you a number where those things have already been deducted, your objective is to add them back altogether. And when you add them back, the reason is that you are trying to make the number EBITDA and not cash altogether. So again, we are not doing this to make it cash. We are doing this to make it what? An EBITDA multiple. And I've seen candidates who will then be asked to provide reasons. And they'll say, add back depreciation, which is correct. And they'll say reason, because it's non-cash. That will be incorrect for the purpose of this technique. And you will not be given a credit for that. So you need to say, add back depreciation. Reason, because I'm determining EBITDA altogether. So just be aware that if you found that you didn't get marks somewhere because of that, it is because your reason was not addressing the valuation technique. The valuation technique is not trying to make this what? Cash. It's trying to make this an EBITDA. So after you then determine the EBITDA, the adjustment that you make are the same. Once off, non-recurring item, items to be valued separately, and items what? Items that are not at market. But then the idea there is that you will end up with what? Is that you will end up with adjustments that are pre-tax. Don't forget about that, because you are trying to determine earnings before tax. So all the adjustments that you make, they will need to be on a pre-tax or gross of tax altogether. And in addition, after you've determined your multiple, then the idea is that you will end up with value of the enterprise. You will not end up with the value of equity, but you will end up with value of enterprise, or what they call market value of invested capital, MVIC. That is what you get. And because we are trying to determine the equity value, you need to say that, wait, the effects of capital structure were not taken into consideration because the earnings are pre-interest. And if the earnings are before interest, then the next adjustment should be to deduct debt altogether. And the debt has to be 1, long-term debt, and 2, it has to be at market value.
When you deduct the debt after you've calculated the value?
Of enterprise, yes. Then everything else, 100% the same. Are we all clear? So add cash afterwards, minus add non-operating assets, add your controlling premium, minus your marketability. So the only difference is, one, you are starting with a number that is what? Before interest, tax, depreciation, and amortization. You get to the multiple, same logic. Adjust for what? For all the positive and the negative factors. After you've got your maintainable earnings, and you've got what? And you've got your multiple. You multiply those things together to get the market value of invested capital. And from that, you deduct debt. And after you deduct debt, you are back here. You'll then have to add cash, add non-operating assets, and so on and so on. Are we all clear? Yes.
I'm assuming now for the maintainable earnings, the reason that you're not saying highest multiplied by 3, something else multiplied by 2, something else multiplied by 1 divided by 6 is because that's 1 year.
Oh, you mean that's weighting? Oh, yes, yes, the weighting, we're going to talk about it. Yes.
So that's for one, it's if they had 1 year.
Yes. I'm just trying to check. Yes, if they've got 1 year. Yeah, but we'll talk about that separately, yes. Mm-hmm.
So this EBITDA and MIVC are the same.
No, remember MVIC is like the value. EBITDA is the earnings part. So we are saying that the value of your capital is based on the earnings. Which earnings figure are you talking about? We are talking about the earnings before interest and depreciation and tax earnings. And the MVIC, it is the value of the company.
That you will get after you do.
Multiply or capitalize your earnings. So,
The multiple, does it remain the same?
what do you mean it remains?
When I multiplied with the PE multiple, the maintainable.
No. So we're going to multiply with the MVIC. So the MVIC EBITDA. So the way these techniques work, so if I say MVIC EBITDA, I'm saying that I need to multiply with what? With EBITDA. And I'm going to get what? MVIC out.
Also, if you say the multiple times EBITDA, you get MVIC.
Essentially, maths will say they need to cancel off. So that's why we are left with this. That is the logic, mathematically. So don't mind whether the EBITDA are the same. Mathematically, we're just saying that this will cancel each other and you'll be left with this. So that's why for a PE, it's P over E, which is earnings. And when I multiply with earnings, the E cancel and I get P. And P is the value of equity.
So how do we get market value of invested capital? How do we calculate that?
When we multiply these two. Or are you not asking that? What are you saying?
No, because you're saying we're dividing MVIC by EBITDA. So
But remember that this is a multiple. Remember that this is a multiple. It's an MVIC to EBITDA multiple.
so they're going to give it to us.
Yes. Or if they don't, they'll give you these two numbers and you can just do the division. But this, remember, it relates to the proxy firm. This is not ours. So they will say to us that there is a listed proxy firm and it's got an MVIC of 10 million and it's got EBITDA of 5 million. So we can then say 10 divided by 5. But otherwise, they will then say to us, we've got a proxy firm with an MVIC to EBITDA multiple of 2. So generally, that's how it will work. Yes.
And the EV, EBIT.
EV is just another name for MVIC.
Okay, now the EBIT leaves out the depreciation and amortization.
Yeah, they will be in there. If it's EBIT, it means we do not adjust them out.
And multiply of the books, we don't adjust it. Once we determine it like that, we just use it.
When we determine what?
Like when we have like market
No, it always has to be adjusted. So the adjustment for that does not differ.
We adjusted before we're gonna multiply it with
Yes.
sustainable.
Yes. And the logic is that you adjust it for the difference between the proxy and the valuation subject.
Okay.
So it's the same way we did it for PE. So here I'm just highlighting what is the difference between the two techniques. So everything else is the same. So you are starting with the EBITDA of the valuation subject. You're going to make the earnings EBITDA, right? That's the first one. Then the second thing is to adjust for non-recurring once-off item. Adjust for non-market related item. Adjust for what? For items to be valued separately. Then you've got your maintainable earnings. But now the maintainable earnings is EBITDA. Then you go and look for the related multiple. The related multiple here will be MVIC to EBITDA multiple. Then I'm going to say that what are the differences between the valuation subject and the proxy. Then I adjust for them. After I've adjusted for them, now I've got maintainable earnings and I've got what? I've got the adjusted multiple. So I multiply the two out. And the other time I said you get a number net of debt. But for MVIC, you get a number gross of debt or before debt. So the first thing that you then need to do is to deduct debt.
This multiple saying, what does it mean?
What do you mean?
That multiple, what does it mean? Because we're dividing invested capital over EBITDA. What does it mean to me as someone who wants to invest in this company?
Oh, you mean?
Yes, what does it mean?
Oh,
What does it mean?
it means. Let's explain the P. It's usually easier. So we are saying that you are looking at something that I'm doing, and I'm telling you that I am currently making 10 rand. Then you are saying that, oh, that's very good. I want to be part of it. Right? You want to buy your own asset that will give you 10 rand for the next couple of years. So the logic is, how many years will it take you to get the investment that you're putting in? So if that asset is costing what? It's costing 80 rand, and it makes 10 rand per year. How long will it take for you to get your 80 rand back? It's 8. That's a PE. So a PE refers to the number of years that it takes to get your money back from the earnings of the company. Are we together?
So I wanted to know, what does the MVIC stand for?
Market value of invested capital. So to simply put, it means that the value of equity plus the value of debt. Right? The value of equity plus the value of debt. So this is what you will say when people ask about what is the market value of the house. They're essentially asking what is the market value of the invested capital altogether. So when you say that my house is worth 2 million rand, you are giving me the market value of the invested capital. Then my next question is that, how much are you still owing on your house? Then you'll tell me, my loan or my bond has got what? 800,000 balance. Then I will deduct the debt so that I can say to you that the equity in the house is what? 1.2 million. That's that logic here. So when I come to you and say, what is the market value of the invested capital of this company? I'm saying, what is the value of debt and what is the value of equity? So that is why the first thing that we want to do is to deduct debt to get the value of equity altogether. That is the logic. Does that make sense? Market value of invested capital. So some textbooks call it what? Enterprise value. So same thing. Of value to the firm. That's the same thing. Make sense? Questions? So that is the earnings-based valuation technique. So let's quickly talk about the NAV. The NAV, to start it from scratch, when is it appropriate to use NAV? Sure.
Earnings yield, like it's the same thing as PE, the difference is that we are dividing.
Yes. So even this will then be done afterwards. Yes.
And the weighted average calculation that I think you're asking about.
Yes.
How do you?
Thank you. So the weighted average earnings approach is now when you are saying that you've been given historic, remember that I said one of the requirements is history, right? So I could be sitting here and saying that we're in 2019 and the earnings in 2019 are 100. In 2018, it's what? It was 80. In 2017, it was what? Let's say 60. Right? So looking at this, I want to know whether this company's growth is actually sustainable. Because as I said, I need to pay for the maintainable earnings. So if it is growing, I have to pay for the growth. But if the growth is actually tapering down, then I need not to pay for that growth. And if we do a growth from here to here, what is the growth? It's about 33%, right? Then from here to here, it's now 25. Now going forward, what is the growth of this company? So because it's all over the place, I don't have any reliance to put on the 100 growing by 33% or 25 altogether. So as a result, in estimating my maintainable earnings, they are saying that I might need to weight the earnings. And from an exam perspective, as long as you've got history like this, I would say do a weighted average calculation altogether. And the weighting will then say that the earnings that is closer to us need to get the greatest amount of weighting. So this will get, we've got 3 earnings, so we'll attach 3 to 1, meaning that the earnings that is closest to us gets a higher weighting, and those that are further out, they get what? A lower earnings, a lower weighting. Such that 60 times 60, it's 60, 80 times 2, and this is now 300.
I understand it differently.
Okay?
Because I've always understood it to say that you need to look at the trend. If there's a trend where your earnings are increasing every year, then you know there is a trend that you're.
But sometimes this one there's no trend, because normally if there's a trend, yes, you take like that.
You
The
take
weighted
the-
average,
the
there isn't a
2019.
trend from my understanding.
Yes,
Weighted
you do it when there is no trend.
Where there is no trend, then you do the average, right?
Yeah.
But if there's a trend, then you
But
just
this one
take
there's
your.
a trend.
Mm.
But there is a trend because
But
it's
this one
growing
is a
every
trend.
year.
Every
But
year.
it's not growing at the same rate.
You don't look at the actual. Or you don't look at the
Rent figure. Yes.
figures.
You look at the real percentage.
Oh, okay. I'm
Yes.
sorry, look at the figures.
Huh?
Okay, I would have said there is a growing trend, so I would have regarded my maintainable earnings to be 100.
We are 100.
And that is the thing with valuation, is that to me is not wrong. And even to the examiner, in some cases, it's not wrong. And in most cases, you'll find where they use this, they always have an alternative for someone who will say this is a trend. So this, I always say that it's a safe way to do it, because even if you are saying you're worried that your numbers are wrong or you are not sure whether there is a trend, then you rather just do this because it's always an alternative. So I'll say this is a very nice way to buffer yourself or to hedge against not getting the marks. And in most cases, remember that for you to actually get to what the examiner said, you have to probably have what? Have had numbers along the same as the examiners. And you're saying that there was some adjustment that you were doubtful of, so this will always be put you at a safe position. Do you understand? I will say even do not necessarily test the trend, just then say that we might need to wait, average it out. It's always the safe bet. Then the idea will then be to add it all up to give you what? To give you 520 divided by 3 plus 2 plus 1, which is 6. And that will be your maintainable earnings. So in terms of the point at which you do it at, you do it after you've adjusted for the once-off items. Do you understand? So that part you cannot skip. So you'll adjust for the once-off items, and after that, you'll then consider the trend.
And then, like, on 1, 2, 3, like, why did you put 1, 2, 3?
It's maths. That's just pure maths.
Right?
Yes.
There's no reason behind it.
There is a mathematical reason. But we don't care. Yes. Don't worry about it. Just say that if you got 4 numbers, it's 4, 3, 2, 1. If you got 2, 2, 1.
But where, like on 2019 or 2020?
The closest to you gets greater weighting.
Yeah.
Yes.
I think you said it.
Hmm?
I don't know. I'll check this.
Okay. Are we clear? So 1, you do it after the adjustments. And the most recent earnings get the greatest weighting altogether. And this will then be your maintainable earnings. You need to multiply with a multiple to get to what? To get to your enterprise or to your equity value. All clear? So quickly, NAV. We are saying that when is it appropriate to use NAV? 1, we use it as a reasonability test, okay? But when? When is it so, and where else? If the entity is no longer a going concern, it's what? It's liquidating. So in other words, it's planning to sell all its assets and liabilities today.
Like the recognition in case true.
Yeah, but not so, because here that one is still going concern. You're just selling it to someone.
Yeah,
But
they liquid it, but you're de-recognizing it.
yes, but and it does not need to necessarily be at the same transaction, because that one you are selling a business together. But here you are saying that I'm calling it quits. I'm done. So to liquidate, it can actually take you a very good 2 to 5 years. Because 1, you are still finding buyers and you're selling the assets individually. So you can actually find the buyers for this today. Then for the desktop, you can find them next year. Then for so on, you can find them 2 years later, and so on and so on. So liquidation is a very complicated procedure, but the idea is that now you're saying, I'm done. I'm liquidated. I'm no longer going concern. So do not value me based on my earnings potential, because I don't plan to generate any future earnings. I don't plan to generate any future cash flows altogether. So that is the primary idea with this, that we are using this to just say that from a reasonability perspective, I want to get a sense that if I close today, I should get less money than if I were to operate altogether. So as a reasonability, we expect NAV to always be at the lowest, because almost each and every business needs to have what? Needs to have prospects to grow, and those prospects to grow will be factored into the multiple, and as a result, will then have what? A higher value based on earnings. But if I'm calling it quits today, then I'm saying that the value of the assets will be valued based on probably what is the price that someone can get this somewhere else. But they will not consider the fact that the assets are put together to generate value. Is that clear? It's like sitting here and I'm saying that I'm buying a taxi. Buying a taxi on its own, I need to consider what is the cost of a new taxi. But now if you're selling me your taxi with a license or an operating license, then now I'm willing to do what? To pay more, because the two are coming together. There is value when the assets are going together as part of earnings potential. But if they're individual, I might need to say how much is it to get this asset individually, how much is it to get that asset individually. Is that clear? So the logic here is that all the assets need to be measured at what? Measured at market values. And because we are assuming that we are selling them, any tax implications have to be what? Have to be considered. Are we together? Because I'm selling, so they're likely going to be recoupments and capital gains. Are we together? But the idea here is a bit subtle because they're assuming that you're doing IFRS. And if you're doing IFRS, all the assets on your balance sheet or statement of financial position will have already taken into consideration the tax effects of potential sales. Are we together? So the reason I'm saying this is that they will do this. They will say that there's a company. The company has got PPE with a carrying amount of 100 million, right? Then the fair value of this PPE is 120 million. So that means this PPE will be sold at what? At 120, right? And now I'm saying that since you've already accounted for the 100, if now I start with NAV, NAV being assets minus my liability, I'll say that the asset of 100 million, let's say that it was what? It's got debt, and the debt has a balance of 60. So I'll say that my net asset value is 40, right? For instance. Then I'm saying that the asset has been undervalued. So if I'm to sell it, 100 million has already been taken into account here, right? So what I will need to do is to provide for the 20 million that was not already provided for. Then I need to provide for the tax implication. The tax implication will be the tax implication on what? On only the 20, not on selling the entire asset, because the assumption is that any other tax effects are included in the liabilities through deferred taxes altogether. So do not assume that the asset will be sold at 120 and therefore the tax effects will be for the entire 120. Assume that the other tax effects have already been accounted for, and now you are only worried about what? You are only worried about the tax effects relating to the fair value adjustment.
Okay, I was thinking, what if you go the route of saying 120 minus 100, then you have 20, then you calculate the 20, would that be different from?
No, you'll end up at the same place.
Oh, okay, because I think that one is easier than going to the date and.
So would it have been wrong to consider CGT then, when you put in tax? I mean, I've never seen this. But
Yeah, so essentially it will be inappropriate to so this will actually be not appropriate, it will be CGT in most cases depending on the context. But I don't think they will take it to that level, hopefully. Yeah, let's hope so. Because usually the idea is just for you to appreciate that you need to fair value the assets and you need to provide for the tax effects. Where we have seen CGT was at an ITC question, and that was a very long time ago. But I just to acknowledge that it does happen. Yes.
Sorry, I'm not sure because I did a question that had considered the tax implication. I'm not sure if there was also recoupment in that question.
Yes, so that could be the case, yes.
So, okay, so if there is a recoupment,
Mm.
is it when they've actually sold some of the assets or?
So they will still be considering the tax effects. So they could have said to you that this asset that is 120, that is currently at 100, it was acquired for 110. So if it was acquired for 110, this additional valuation is gonna, 10 will sit below the cost and the other will sit above the cost. So there will be some at CGT rate and some at 28. Yes.
I was actually confused because it was the first time I saw the tax implication really in the movie.
Yeah. So yeah. So I always think it's unnecessary complication at this level, but at ITC we've seen it. I think for CTA level 1 it's unlikely to be there because some of the guys that are doing the module are not doing advanced tax. So I doubt you'll see that. Because this, your CGT and the fact that if it's above cost, it's now CGT rate, that at some basic tax courses, they don't focus on that.
So, I just wanted to check, are we following the same logic when we're using the first method that we use, the earnings-based one, where we deduct the non-operating assets?
Because when we liquidate, every asset has to go. So when I liquidate, I don't care whether this is an operating because I'm no longer operating. So all the assets now are looked at the same. I need to let them go. So yes, I've got a building and I was a retailer. I didn't have anything to do with that building. I was renting it out. That doesn't matter. It has to go at market value. So that's why even here, there's no need to talk about there's a controlling interest, there's non-controlling interest. Because there's nothing to control. The business is going. So we don't have that discussion that we need to do a marketability discount. Because the company is no longer an unlisted, it's gone. That's what we are saying. So no discussion about marketability discount, no discussion about controlling discount, controlling premiums, and so on and so on. We're just saying all the assets are going. So whether they're operating, non-operating, they're gone.
I'm actually asking about, you see where we did that, the PPE CV, and then the fair value, where we had the 20 million difference, we went adjust the tax. I'm asking, when we're doing that earnings-based technique, where we have those, what you call it, non-operating assets, where we deduct those ones. If ever there was a fair value gain or loss, do we also account just for the gain part of the tax?
Remember that from an earnings-based valuation, I'm saying that the value of this asset is not linked to the price to sell it, but it is linked to the value that will be generating through future earnings. So when I value the earnings, the revenues, then I'm essentially valuing all the assets that are used to generate that revenue. So you should not provide for additional fair value adjustment because you'll be double counting. Does that make sense? And the reason I'm saying this is because in one question, you might find that they will tell you this information and you will need to ignore it for the purpose of earnings based. It might be for the purpose of NAV only, altogether. Does that make sense? So that is the NAV. So the NAV, one, we use it as a reasonability check as well as what? As well as a liquidation value. And the way that we do it is that all the assets are assumed to be sold at their market values. And if there are some assets that are not at market values, we'll need to do a market value adjustment. A market value adjustment will then give rise to what? Will then give rise to tax effects altogether. I think if you ever get a tax effect that you are so unclear with, I'll say just multiply it by 28% to save time altogether. But if they go to the detail where they give you the carrying amount, the cost, then it might be that they want you to also consider your CGT. That is how you'll pick it up. But other than that, I'll say all the adjustments have to go at 28%. And remember that the adjustment will always work opposite to the tax. If the adjustment is increasing, then the tax should be in brackets. If the adjustment is going down, then the tax should be in positive. Makes sense? So that is the NAV. So the NAV, if it comes, I think it's always a one way you need to optimize, because it's all about, are all the assets sitting at fair value or not? So it was also here, and it was just what, 2 marks. And you also see that it was what? A matter of just A minus L with some assets that were not sitting at what? At fair value.
So, if I'm given financial statement and I'm calculating an income, that, so I'm gonna take equity value, that's it, and then adjust for assets which were not accounted for.
Exactly. So it's equity value plus your fair value adjustments. Because the idea is that you are selling the assets and have to pay off your liabilities. Make sense? Okay, let's take a quick 5, and then we'll quickly look at the papers, just to see how some of this was tested. But I just want to extract this particular section so that you can just quickly have a look in terms of how you are expected to pick it up. So let's take a quick break.